all the time or most of the time that the dollar is credit, right? But it is. And what that means is if that government is getting shakier, either fiscally, monetarily, socially, obviously internationally in terms of war, whatever, there's any number of things that can make that government less sure of being not only in power, but enjoying the current level of privilege that it has. If anything calls that into question, you don't want to be that creditor. You want to dump that credit paper. And as soon as you want to dump that credit paper, you look around the financial universe, every other kind of thing is effectively denominated in that same credit paper. But there's one thing that doesn't have that problem. It's gold. It's not a credit obligation. There's no counterparty that has to make good on it. And if that counterparty fails, then gold becomes worthless. It's not how gold works. What I do know is that other central banks in the world have begun cutting interest rates, it's obvious the Fed is going to cut interest rates, and not because they want to. I mean, they are trying to maintain the pretense, as they've done for 40 years of falling interest rates. They're trying to make the pretense that, it's just this little crisis, just this little blip, just this little market, glitch. We'll get interest rates back to normal. It's a steady downslope for 40 years. Where along this slope would you point to and say is the normal point? There's no reversion to mean. It's just sliding and sliding. And I've written an enormous volume of articles and words about this and why the interest rate is falling. And it's secular and it's durable and it's pathological. And that's how the system comes to an end in the end. Is by we're drowning in falling interest rates. And post-COVID, everyone said inflation, and they said exponentially rising quantity of money, and that's going to mean the dollar is going to have to sell off. We're going to have massive inflation, and the treasury bond is going to have to sell off. And the first thing I point out is that there is no actual real way to hold dollars and not finance treasury bonds at the end of the day, right? So either you hold a dollar bill says right on it, Federal Reserve note. So you're giving the Fed credit, and the Fed uses that credit to buy treasury bonds. So you're financing the treasury bond one for one with every dollar bill you hold. Or you could buy treasuries directly. There's treasurydirect.gov or .com or whatever it is. Or you can buy it in most brokerage accounts. Or thirdly, you can put a deposit in a bank. And what is the bank going to do? By statute and by business models, they're going to buy treasury bonds. There really isn't any way to separate the two. The idea that people think there's inflation, interest rates have to go up, just isn't true. It just doesn't. The system just isn't wired that way. And I like to use the example of suppose you're watching a Formula One race and you have an Xbox video game, and you have a toy steering wheel and gas and brake pedal controller, and you see that driver is headed into a curve, and you think he's headed too fast, and you want to tap the brake on your Xbox controller. It isn't wired to his car. No matter what you do on your toy, right, it's not going to affect the real car. And anyways, I've been saying, look, interest rates are going to resume their falling trend. Everyone's like, Keith, you're nuts. Inflation, look at how much the money they're printing. And I was like, if an increase in the quantity of dollars, which you call printing, I won't quibble about that right now. If an increase, especially an exponential increase, caused interest rates to rise, then we would have had rising interest rates post 1981. Because certainly the quantity of what we call money was rising exponentially all during this time. But it's not true. It just simply isn't. So we're now at that point where the Fed, and they don't really want to. They really want to prove that, we're independent and we're doing the right thing. Monetary policy is bi-directional. It goes up as well as down. They really want to prove this point. And I think they have something to prove because, if you look at the facts, it's pretty clear it's the opposite. But as, things get worse in the parts of the economy they care about, then they're forced to lower rates. And so you get kind of a weird dichotomy where, if you just look at what I think should be econ or finance 101, net present value. right? If you add up a bunch of cash, payments that extend into the future, each one of those payments has to be discounted to the present. You add up the sum of those, that's the net present value. And the discounting factor is the market rate of interest. That's my argument. I guess other people may use it different. But it is certainly a simple function of the math that the lower the discounting factor, the lower the interest rate, the more that all those payments in the distant future are worth in the present, right? So if the interest rate was zero, if the discounting factor was zero, then a payment to be made 20 years from today is worth the same today as it would be in 20 years, which is the contradiction of monetary policy anyway. But so asset prices, ceteris paribus, economists love to say that, it's a term meaning all else being equal. If the interest rate falls, then asset prices should rise. But a lot of people point out that when the interest rate falls, asset prices fall, not rise, and they think the theory is wrong. But actually, there's a simple answer to that, which is, no, the theory is right, but there's a reason why the Fed is cutting the interest rate. And that's the reason why asset prices are going to fall, which is there's real stress in credit land out there. By hiking interest rates so high, the government has starved the private market for credit that it so desperately craves. And, that first hits the margin. It hits much bigger companies. Intel just announced they're laying off 10% of the workforce are going to be gone in a couple of months. But they have an aversion in the mainstream to gold. It's a 4-letter word. They just don't like it. And if you say gold in polite company, you're like outside the Overton window. Everyone's like, ew, who let you in here? You're one of those. And, so they'll talk about if they're forced to, but they don't like it. For all the reasons of everything that gold stands for. And, so they'll talk about the gold bull market, of course, especially if there's eyeballs that are, turn into ad revenue. But reluctantly and probably belatedly, grudgingly, and then, as soon as they can, oh yeah, is this the top? There'll be a lot of stories. Is this the top? And that's the bull market's climb, a wall of worry, right? I don't know if that goes back to Jesse Livermore, who was the origin of that quote, but, that's exactly what it is. And of course, it isn't really a bull market in gold. It's a bear market in the dollar. It's the quality of this thing we call dollar. It's just, declining. It's in a, it's a punching bag that everybody's, especially the U.S. government is abusing. And, so that doesn't necessarily manifest in consumer prices, which are driven more by interest rates, but people do think of gold as, a way of opting out of the game a little bit. And, now to put in a plug for my own product, I think the thing that ultimately makes gold, you said, what would make it respectable, is when it earns a proper yield. And it's a proper financial asset. It's not something, most people don't really want to bet on a lump of metal, as Warren Buffett would put it, that price is going to go up. Even if its price is going up, most people don't really psychologically want to make that bet that way. But if it's something that earns a return, a whole different story. I was one of the voices that was, naysaying all those predictions for, a decade post, the big high in the crash in 2011. And every time the price would blip, they'd say rocket launch, and they'd show pictures of, rockets to the moon and all that. And it's just not going to happen. Look at the data, look at what's going on. This is going to reverse itself. It's going to end in tears. And from 2012 to 2018, it always did. And they hated me and they called me perma-bear and all that. We have a model. I think I said the last time I was on your show. Charles Box has a famous saying, and certainly in data science, machine learning circles. All models are wrong. Some models are useful. So we have a model, and that said, that tries to figure out what the price would be if you back out the action of the leveraged speculators in the futures market. And our model is currently saying about 31.5 for silver. So it's significantly above the market. And, whether the price of silver hits 31.5, tomorrow or Monday or next week or whatever, isn't the point. The point is there's a tension, that wants the price to go higher. and so most likely, continue in that bull market. It's interesting that, the price of gold's an all-time high, and the price of silver is, 40% off the price that it was in 1980. There's a world of difference between the two. So I'll just share one anecdote. So we have a silver bond right now to finance a silver producer. It's called Bunker Hill Mine, paying 12% net to investors. And the point of this isn't to plug that, although that is open and anybody who wants to return on their silver can contact us. But so we're talking to, a good client of ours, a pretty large investor, who's very, savvy about mining, and he's very interested in gold mining deals, and he's participated in our gold mining deals. And I asked him, okay, what do you think of the silver deal? And he said, yeah, I think it's a good company. I know some of the people. He said, no interest in silver whatsoever. And I was just kind of like, raised the eyebrow, oh. And he said, those, beep, beep, been predicting silver is going to be, $50, $100 since forever. It's never happened, not going to happen. I'm just not interested in silver as an asset class. I'm sure the bond is fine. I'm sure the mine is okay. I just don't believe in silver as an asset class. Too many broken promises, too much money lost. I'm done with silver. And, is he typical? Fortunately not. We certainly have many, many investors that are interested in the bond. But it just goes to show you kind of the sentiment around it. Silver has a much bigger wall with a lot more worry sticking to it than gold does. Now, the thing with gold, certainly, and silver, probably following along with some lag to it, is, people don't really think of what we call money as a government credit obligation, because if you allow, there's certain things, I almost kind of think of it as like, you take a cast iron skittle and you put it on, high heat on the burner until the skittle is not quite red hot, but really, really hot. And then you splash some cold water on it. You get this bead, and that bead kind of skitters off. It doesn't really it just wants to move, not even necessarily downhill, but the steam where the water is touching the iron is so ferocious, it'll push it in one direction or the other like a propellant, I think. I might be wrong on the physics of this. They could tell me, no. You're going to have some reader who knows the physics of it. Keith is a complete idiot. This is what really happened. But I don't think it's because it's sloped. I think it skitters off for some other reason. But anyways, there are certain things where you can see people's minds skittering like that bead of water, off certain topics. Like they can't go there. So if you, in your mind, really truly grasp, and all the way to its profound implications, that dollar bill isn't money, the dollar bill is a credit obligation of the government. When you realize that, then you kind of have to say, well, wait a minute, that means it's not money. Like, credit is a promise to pay money. So this is credit and it's money. Like, there's a contradiction there. And so people shy away from that, and they don't necessarily think, even if you buy a piece of real estate in America, it's effectively denominated. No, it's not a credit derivative in one sense, but it's, as a financial asset, if you think of storing value in it and then you want to sell it, you can only sell it for dollars. This is America. If it's in the UK, you're selling it for pounds. And so people turn to gold in times of uncertainty because they don't want to be creditors to an uncertain debtor or obligor. And silver follows along with, for that story. And I certainly think that's true. And I certainly think all around the world, there are a lot of governments and a lot of people that would love to, reject the dollar and adopt something else. The problem is exactly what and how you're going to do that, and they're trapped. It's the perfect game theory, pseudo-stable equilibrium. I don't know if that's quite, I'm not an expert enough to know if that's the Nash equilibrium, but something like that, pseudo-stable, and everyone's trapped in it, and there isn't really, a way out of it. But there's certainly a lot of people who want that way, and, most of those people do buy some gold, if nothing else, as a call option on some other alternative monetary arrangement. As I said, I decided I wanted to try to avert this disaster. And the disaster really is because we have this irredeemable currency. People call it a fiat currency, which is true. It's imposed by force. The government dictates it, and that's why we use it. But I call it irredeemable because economically, that's the salient point. That it's a promise to pay that says right in the fine print that it will never pay. So you just get a government credit, and when we pay debts using government credits, which means we pay a debt using an IOU, and so the debt is never extinguished. It's just merely shifted from one party to another. And so the debt grows exponentially. It grows by at least the accrued interest, and actually a lot more than that, because you have to, if you're managing the system, if you're the Fed, you have to try to somehow manage it so that the marginal debtor can get his hands on enough dollars to service his debt. Otherwise, the defaults begin, which possibly is what the Fed is fighting right now.